Welcome to the Deep Dive. We take stacks of sources and really unpack the important stuff for you.
Yeah, we dig in so you don't have to.
Today, we're diving into Creative Realities, that's ticker CRI, and their first quarter 2025 earnings call.
Right. And CRI, they're in the digital signage game. Think screens in restaurants, stores, stadiums.
Yeah.
Helping businesses engage customers.
Exactly. And Q1 calls, they often have this timing dynamic, which definitely came up here. But there's also, well, a much bigger story about future growth that management spent quite a bit of time discussing.
Yeah, that's right. Looking just at the Q1 numbers, you might think, a bit soft. But when you dig into the details, you see these strategic moves, pipeline developments. It really sets the stage for a potentially very different second half of the year and into 2026.
It's kind of that classic case, isn't it? Big projects, timing hits one quarter's results.
Precisely.
Okay, so let's quickly run through the numbers snapshot. Q1 2025 versus Q1 2024. Revenue was $9.7 million.
Which is down from $12.3 million last year.
Yeah. And management was pretty clear this was mostly about installation timing on big projects they'd already won, stuff getting pushed out.
Right. Revenue recognition timing. And that revenue dip, naturally, it slows down. Gross profit came in at $4.5 million compared to $5.8 million a year ago.
But interestingly, the gross margin percentage held up.
Yeah, that's key. It stayed right around 46%, pretty much in line with last year. So on the revenue they did book, they maintained their profitability.
Okay, but here's a metric that moved up. Annual recurring revenue, ARR. That's the sticky stuff, software and services.
Right, the predictable stream. That kept climbing. Hit a run rate of $17.3 million at the end of Q1.
Up from $16.8 million at the start of the year. So while project revenue was lumpy, that base is growing.
And, despite that lower overall revenue number, adjusted EBITDA held stable at $500,000.
$0.5 million. And adjusted EBITDA, just as a reminder for you, it strips out interest, taxes, depreciation, amortization, gives you a clearer view of core operational profit.
And they manage that stability mainly through cost control. SG&A expenses, selling, general, admin, down 11% year over year to $5.2 million.
And even down sequentially from Q4, right? $5.6 million then, $5.2 million now.
Exactly. So those cost controls were pretty crucial in holding that profitability line.
Okay, balance sheet check. Cash was about $1.1 million. The thing that really jumps out, though, debt.
Yeah, gross and net debt increased quite a bit. Gross debt ended around $23.2 million, net debt $22.1 million.
That's up from, $13 million gross and $12 million net at the start of the year? That's a big jump.
It is a big jump, but it ties directly into a major strategic move they made during the quarter.
Ah, right. This resolves that issue hanging over them from the Reflex Systems merger back in 22.
Exactly. The contingent liability, it was based on post-merger performance, sat at about $12.8 million at the end of last year. It was actually due in February this year. It was a significant overhang.
Okay, so let's unpack how they settled that. It's a bit involved. They settled that $12.8 million liability for $7 million.
Correct. And the payment breakdown was $3 million from their credit facility. So that increased their drawn debt there, and the other $4 million through a promissory note.
A note due September 2027 with a balloon payment.
And there were some warrants involved too, right?
Yes. Warrants were part of the package. So you see, well, the gross debt number on the balance sheet went up quarter over quarter because of that draw and the new note. Plus, they used about $3.2 million for working capital. You have to look at the net effect, including that original liability they just wiped out. They got rid of a $12.8 million obligation by paying $7 million.
Okay, so if you look at the total picture, the old liability plus old debt versus the new debt structure.
They actually reduced their total reconstituted debt obligation by about $2.6 million. Management really emphasized that clearing this liability gives them much better long-term visibility and flexibility. It removes a huge unknown.
Got it. So yeah, short term, the balance sheet looks like debt went up and the leverage ratios did tick up.
Yeah.
They were 4.91 gross, 4.67 net. Right. But strategically, they took a bigger near-term problem off the table. And management's focus now is on optimizing that capital structure, expecting leverage to improve as earnings grow.
Okay, so that's the balance sheet cleanup. Let's talk growth, future growth. The call spent a lot of time on project wins and the pipeline.
Definitely. The big headline here is a major win they announced with a well-known upscale quick service restaurant chain, QSR.
We're talking over 1,000 locations, more than 25 states. That's substantial.
It's huge. And the project itself is really interesting. It's about transforming their menu boards, indoor and outdoor.
From static printed signs
to dynamic digital displays, all powered by CRI's own Clarity CMS platform.
Think about that, instantly updating prices, promotions, menu items across hundreds, potentially over 1,000 locations, centrally managed.
And it's a full turnkey solution. CRI is handling everything. The consulting, the hardware, deployment, ongoing service. Management really stressed their expertise in the QSR vertical was key to winning this.
And they gave a timeline, too.
Yeah, pretty concrete. Pilots in select locations starting Q3 this year. Then a national rollout.
And they said over 600 locations have already signed up or expressed interest in converting.
That's right. High interest already. They expect to roll out about 300 sites per year. So you do the math, looks like a likely 3-year project deployment.
Wow. And winning a first-class brand like that, as they called it, that's got to be a big credibility boost.
Oh, absolutely. Should definitely help open doors with other large QSRs or retailers looking at similar digital transformations. Huge validation.
And the overall pipeline sounds strong, too, not just this one win.
Yeah. They described customer engagement as being at an all-time high.
Yeah.
And said the quality and size of their top 10 opportunities have improved significantly.
Plus, they mentioned several other large deals are really close.
Yep.
1-inch line deals was the phrase.
Yep, right on the verge of closing, basically. It helps explain the Q1 timing, too, when you hear about their sales cycle.
Right, they enter maybe 30, 40 RFPs a year.
Something like that. And about half get pushed out, sometimes for years, due to customer budget cycles, But
on the ones that do get decided, they have a pretty good win rate, around 70%.
Yeah, a healthy win rate. The catch, as Q1 showed us, is even after you win, deployment and revenue recognition can still take, 1 to 2 years sometimes.
Okay, let's touch on some specific verticals they updated. Sports and entertainment.
Building momentum there. They expanded the team, leveraging that big NHL arena deployment from last year. Q1 saw 3 new MLB project wins, different sizes and types.
And 7 active proofs of concept at other venues.
Right. PCs, they usually run during the season so the client sees it live with fans. The drivers are fan experience upgrades and, crucially, generating income from the screens via AdTech.
Makes sense. Deployments happen in the off-season.
Typically. They see potential for large, predictable deals, maybe 1 to 1.5 years out, meaning revenue likely kicking in more significantly in 2026.
What about the BCTV project? Any update there?
Pace was a bit slower first half of the year, but they've done over 300 sites total. Importantly, they just got the go-ahead for the next 200-plus sites starting Q3.
Okay, and they expect to get over half of those installed by year-end?
Yeah, projecting about $3 million in revenue just from that block in the second half of 2025. So, picking back up.
And then there was the DigiPoint Media Network update. That's the one putting screens on ice boxes in C-stores and grocery stores.
That's the one. They sound ready to deploy about 2,000 sites, also starting Q3 25.
Wow, 2,000 sites. If they get those done in the second half, that could be over $4 million in hardware and installation revenue.
Potentially, yeah. Plus, crucially, the ongoing recurring SaaS revenue from their CMS and AdTech software.
And what's really key here, they said DigiPoint is adopting their entire tech stack.
Yes, CMS, ad server, campaign planning tool, the whole package. That makes DigiPoint a super important reference site for them, showcasing everything they can do.
Which leads nicely into AdTech and retail media networks. That seems like a big focus area.
Huge focus. Management called the market early game, but there's massive interest. Why? Because it flips the script. Signage goes from just an operating cost
to an income-producing machine for the retailer, selling ad space.
Exactly. And CRI's AdLogic platform is designed to enable that. Targeted, high-performance campaigns, programmatic capabilities, easier execution, maybe even cutting out middlemen.
A one-stop shop, potentially.
That's the positioning.
Yeah.
Now, they see the big revenue impact from AdLogic hitting more in 2026, 2027 as these networks really scale up. But lots of their current and potential large retail clients are looking into this now.
Makes sense. On the operational side, getting ready for this growth, they achieved SOC2 Type 1 compliance.
Yep, in Q1 and targeting Type 2 by year end. For enterprise clients, SOC2 is huge. It's basically a stamp of approval for data security and management, demonstrates trustworthiness.
Kind of a must-have for bigger deals.
Pretty much. They also upgraded their warehouse, revamped the space, significantly more storage capacity.
Minimal cost increase, they said, but positions them for that expected H2 growth.
Right. Handling more hardware efficiently. They did mention pulling some hardware forward a few months back, partly due to tariff worries. But this upgrade seems focused on scaling capacity.
Speaking of tariffs and macro stuff, what was their take?
Current assessment. Signage market, not yet terribly affected. Screens mostly from Mexico. Mounts being steel, could see impacts.
But no customers have actually hit pause specifically because of tariffs as of the call.
Not explicitly, no. They acknowledge the general uncertainty, obviously, but feel they can manage. Mention a bonded warehouse strategy if they needed to do large-scale hedging.
Okay, so pulling it all together for you listening, Q1 results, yeah, lower revenue, but that was expected due to project timing.
And cost controls really worked, keeping adjusted EBITDA stable despite that dip.
The big strategic move, settling that contingent liability, cleared a major overhang, provides flexibility, even with the short-term gross debt increase. Now they focus on optimizing the capital structure.
Absolutely. And then there's the future growth story, which was the main event, really. That huge QSR win is massive validation.
Provides multi-year revenue potential, clear rollout plan, high customer interest, should be a catalyst for more wins.
Combine that with the sports momentum, the BCTV restart in Q3, DigiPoint kicking off and using the full tech stack. You can see why management expects significant revenue acceleration in the second half and beyond.
Right. They're guiding for record performance, targeting a 15% adjusted EBITDA margin by year-end. That's ambitious, but leverages cost control and scale.
And investments like the warehouse upgrade, SOC2, those are about being ready to handle that growth. Plus the longer-term potential from AdTech and retail media networks.
Of course, there are risks. Execution on big projects is always key. Macro factors like tariffs could worsen. Hitting those margins isn't guaranteed. Lots to watch.
Okay, let's shift gears. Time for our This Is Not Financial Advice segment. Remember, this is just us brainstorming an outrageous but plausible trade idea based on the call. Think investment committee pitch.
Our team, gather around. Here's the pitch on CRI. You look at that confirmed QSR win, right? Clear plan. 300 sites a year, 3 years. That's baked in potential.
Then add the DigiPoint network. Potentially $4 million plus hardware in H2 25, plus ongoing SaaS revenue. And they're using the whole tech stack, huge validation.
And management says the pipeline's at an all-time high, quality's up, several one-inch line deals ready to pop. So the argument is Q1's revenue dip, pure timing noise. It completely masks the validated imminent growth wave coming in H2 25 and accelerating into 26.
And they're not just hoping for it, they're targeting record performance and a 15% adjusted EBITDA margin by year end. If they get close to that, the market, which is looking backwards at Q1,
is going to have to seriously reevaluate, completely rethink the valuation.
So the outrageous part, you argue for a significantly higher target price. How? By applying a much richer multiple, maybe 10x, 15x forward adjusted EBITDA, or 1x, 2x forward ARR to the expected 2026 numbers, not the trailing ones.
You're betting the market wakes up to this growth and margin story and re-rates the stock substantially from where it is now.
Catalyst to watch for this playing out. Near-term stuff. Announcing another big one-inch line win. QSR or DigiPoint hitting or beating deployment milestones in Q3, Q4. Early signs AdTech is getting traction on these new networks.
And the risks you got to mention in the pitch. Execution, execution, execution. Big projects are complex. Macro slowdown, hitting customer spending, tariffs getting worse, or just missing that ambitious 15% EBITDA margin target.
It's definitely a forward-looking high conviction play. Relies heavily on them delivering operationally in the next few quarters.
Okay, so wrapping up our deep dive on Creative Reality's Q1 2025 call. The quarter's numbers reflected known project timing impacts.
But cost management was effective, keeping profitability steady. And strategically, settling that contingent liability was a really big deal. Cleared the decks.
The focus was definitely on the future. That major QSR win providing multi-year visibility, momentum in sports, and the confirmed restarts for BCTV and DigiPoint.
Management signaling clear expectations for revenue acceleration and margin improvement starting in the second half, backed by operational readiness and the long-term AdTech opportunity.
And again, remember, everything we've discussed here is based on the earnings call information. It is absolutely not financial advice.
Yeah, please do your own research, look at the source materials yourself, form your own conclusions.
We hope this deep dive was useful for you. Let us know if you have feedback, questions, or other calls you'd like us to tackle.
Thanks for listening.
Until next time.